Okay, I think we'll go ahead and get started. Good morning, everyone, and welcome. I'm Jerry Murphy, and I'm the partner in charge of our manufacturing distribution services vertical, and I'll be moderating this morning's discussion about combating inflation. Thank you for joining us. I think we've got an exciting topic. I know that typically LIFO is a little bit of a scary topic for accountants. It's not something we necessarily have enjoyed maybe in our career. But given the amount of inflation that we've experienced over the last number of months, many of you probably have experienced significant amounts of inflation. And I think now it's time to evaluate the benefits of implementing LIFO. So this morning, I have two of my colleagues, Silas Babu and Jim Brandenburg, who will be presenting on this topic. I encourage you to submit questions throughout the webinar. You can do that in the control panel. I'll be monitoring those questions. We'll be sure to try to get those answered before we wrap up our 1-hour presentation. And if we can't address during the presentation, our team will follow up after the webinar and send you a response via email. The presentation slides can be downloaded from the handout section of the webinar control panel. So if you're interested in downloading these, you can do that now through that handout section of the webinar control panel. We will be having polling questions that will launch throughout the webinar that will help us to achieve our CPE credit for attending today's presentation. You will get 1 hour of CPE. And at the conclusion, there'll be of the webinar, we'll have a short survey for you to complete, and then we will have your certificates for the CPE emailed to you probably in the next 2 to 3 weeks after the program. So with that, I'm going to go ahead and let Jim Brandenburg introduce himself and present, and then he'll switch over to Silas a bit later in the presentation. Jim?
Good. Good morning. Thank you, Jerry, and good morning, everyone. Thank you for joining us today again on this presentation, Combating Inflation. Again, many companies have seen and you either experienced or heard about the inflation out there. We're going to address that, and I'm going to be presenting, as Jerry mentioned, some of the tax considerations with LIFO, and then Silas will go through some of the financial reporting issues that are important with LIFO as well with it. So again, we, as Jerry mentioned, we encourage any questions you may have with LIFO, feel free to put those in the chat feature, and we will address those as we can. So here's what we're going to look at. Again, our agenda. First, we're going to cover the tax items. Then I will cover that. Again, I'm a tax partner here with Sikich, and the main reason, again, the companies look to LIFO are some of the tax benefits with it, because you know, the higher the inflation, you get the more of a tax benefit with LIFO. So we're going to look at those tax considerations that you have, and then you know, with the financial reporting requirements is also part of it that Silas will cover. So next slide. What we've got here is just the agenda of some of the topics we'll be covering on the tax side, the benefits of it, how inflation affects it. We'll talk on the IPIC, which is a sort of a specialized method with determining your inflation part of LIFO, just how you adopt LIFO, just some of the steps that is involved in that process, the management's role with it. Then there's several examples and illustrations that we've got included, you know, with that. And then just a couple other items at the end. There is a relief measure that's available if you that the tax law provides for, that the IRS needs to provide that relief for it. And then just a couple thoughts and comments on LIFO and any M&A transactions, and then any possible changes that Congress could make with it or not make with LIFO. So anyway, a number of items we've got here. Let's just get started with the tax benefits of LIFO. Again, that's the primary reason that companies look at LIFO, is the tax savings with it. Again, what LIFO allows is, the main thing is, it allows a business to deduct its higher current prices or of manufactured or purchased costs, the inventory against the current sales that they have. So it's LIFO is often said is it better matches the current cost with the current sales that a company is encountering. By doing that, again, what it turns into is that those higher costs get to a higher cost of goods sold, which results in what? a higher cost of goods sold results in lower taxable income, and that's the tax savings that a company realizes. And again, one thing just to clear up again, some people have wondered, you know, if you talk about when you go to LIFO, you say, well, you're going to use the current products, you're going to get some old products that are going to sit in the shelf there and they're going to become obsolete. What LIFO focuses on is just the cost flow assumption that you're looking at with your inventory. It doesn't affect the actual physical flow of the goods. So you're not going to have some of the older ones still sitting on the shelf or in your warehouse or your manufacturing facility. It just deals with the cost flow assumption that you work on with it. So it's just something to keep in mind with it. And again, we'll talk about it here with some of the specific inflation numbers, but even a company that has some modest amounts of inflation, even 2, 3, 4% a year, can actually realize some benefits from LIFO. So it doesn't have to be these significant amounts and percentages that you see in inflation to take advantage of it. Next here, again, one thought that we would just put up here is one of the tax benefits, again, is compared LIFO to FIFO. Again, many of you may be familiar with FIFO, again, which is first in, first out, which is LIFO is last in, first out. Again, FIFO treats the first products that a company has as being those sold first. So it's going to get, again, those costs, if those are a little lower costs, you're going to get probably a little higher income with that, okay? And you're probably have a higher inventory for the goods that are left on your balance sheet. LIFO is the opposite. LIFO is going to get those current costs that are a little higher, is going to go through your income and result in lower income, but your balance sheet is going to get look a little maybe out of whack after a while because of those older costs are going to stay on the balance sheet for a while. Both of these, and again, Silas will talk on this too, but both LIFO and FIFO are acceptable methods of accounting for a company to use. So it's not that one is accepted, one is, both are accepted with it. And again, a company can decide which one to use with it. We'll talk about how a company would adopt or go from, let's say, FIFO to LIFO with it. The one thing to note, and you'll see this term come up often, or if you see a company that does use LIFO, is the difference between what its FIFO cost for the inventory is, when its current cost with it, and the LIFO is called the LIFO reserve. And that is again, a difference that captures what the difference between the LIFO measurement of your inventory if you're on LIFO and what the FIFO cost would be of that. And again, that number can change over time and can build with it. And again, that's really represents the cumulative difference that a company has that's been on LIFO for a number of years, and that's a LIFO reserve, so something to be aware of. Again, another tax benefit with it, again, if you use the LIFO, that doesn't affect the company's cash flow. They're still going to have the same operations with it. The only cash flow impact that a company gets with LIFO is actually the tax savings that it realizes. It doesn't affect the cash flow or operations of the company. It's only the tax savings that gets measured, excuse me, with that. One thing that some folks think is that, okay, you adopt LIFO, you get this benefit in the first year, and then that's it, it goes away. What happens with LIFO, it's not a 1 year that you get and then it reverses or it stays. It can continue on as long as if the company has continued inflation with it. That LIFO reserve, again, the difference between your LIFO cost and your FIFO cost, can build over time. We have an example on that later on that shows it. So the LIFO calculation, again, is a function of your inventory, both the inventory levels as well as the prices. So you could get the reserve in the initial year, and then you may have inflation the second year and third year, and that reserve can build. Now, it can fluctuate and come down some, but I guess what you look at is over time, what's that reserve going to do, and it will continue to build with it. So one way to look at what your cumulative savings are is just look at that LIFO reserve, whether the company is in it in its first year, just adopts it this year, or maybe it's been on it for 10 or 20 years. Just take that LIFO reserve, multiply it by what your tax rate is, maybe your federal and state tax rate, 30, 35% maybe, and that's what the cumulative savings are, cash flow savings that a company has realized by being on LIFO. So if a company's been on LIFO for 5, 10 years and has a reserve of $3 million that they've built up, the cumulative cash flow and the benefit of LIFO would be approximately $1 million that they would have built up over that time. It's really what LIFO is, and back up to the one before, size is really a interest-free loan from the government. And it's uncertain if and when that loan needs to be repaid. Again, this LIFO reserve could build over time. You're saving each year with it. You know, if you sold the company, you might have to repay that at that point. But if you don't, this amount, that LIFO reserve, is not only an interest-free loan that you get with it, but that loan could continue to build each year. Again, as that reserve, let's say, does increase, you're going to continue to save with it, but it's an interest-free loan that you're not sure if and when it needs to be repaid. So I think that's an important factor to keep in mind with LIFO. Next with it, I mentioned here, you know, in real estate, everybody talks, you know, location. I think with when you look at product prices and with LIFO, inflation. Anytime you hear any, you know, company management, you know, that they're talking or maybe complaining about the rising prices that they're seeing with their business and some of their suppliers and trying to get that, you know, LIFO would be something to suggest if they're not on it yet. Again, the key part of LIFO, and this is why it's looked at for tax purposes, is the inflation. The higher the inflation, the greater the impact on the cost of goods sold, which the lower the income is going to be and the greater the tax savings. So you can just, and we'll have some examples that will show that a little bit later on. And that's why a lot of companies are looking at it now. Again, with the recent impact of supply chain issues, disruption with that, certain product shortages, tariffs, all these other items that each industry, each company may be seeing, they should be looking at the LIFO. If they're on LIFO, what they may see is they're going to have a much more of a benefit this year. If not, this may be the year to explore it. We're seeing situations again where maybe a company's had some modest inflation in the past. Now they're seeing 10, 20, 50% or more in some cases, which again could provide a significant tax benefit for them, not only this year, but into the future as well with it. So even with stable, the last point here, even with stable or falling prices, again, LIFO is less beneficial with it, but again, it's still something to analyze and take a look at the impact that you're going to have. I thought this was a good slide here that I went to got the October 21 here, the producer price index, which again the Department of Labor does on a monthly basis, and we'll talk about the producer price index a little bit later on when we get to the IPIC discussion. But this just shows some of the recent inflation that we're getting in different industries with it. You know, and the farm products is sort of the category, and within that there's some raw cotton, 64% inflation with it. Now there were 14 different product codes within farm products, and the range was 5% to 64. So again, the cotton was the high end with it, but again, still some sizable inflation in farm products. Processed foods, corn oil, crude or refined, again, a 77% increase. Again, there were 27 products in that code, and again, any range from 3% to 77. Some textile products, again, a little more moderate with it. In that case, it was 7% to 27% with some of the ones. Fuels was an interesting one. Look, with fuels with it, there were 18 different products within the fuel category. Again, the range from that was 5% up to this natural gas, 232% inflation that they looked at with it. Other fuel and related products, again, 114% for crude petroleum, chemicals and allied products, fertilizer materials, again, a 72% increase with it. Some sizable amounts, even lumber and wood products. Again, anybody with that hardwood lumber, a 44% increase with it. And then the last, metal and metal products. There were 33 products in that category with a range I looked at with it from up to 143% with steel products with it. So anyway, again, this is just sort of a cross section of some of the inflation that companies are seeing here. And again, each year that may fluctuate with it, but these are some significant ones that the companies may be experiencing. Now, the actual inflation that you with your company may have, might be more or less than this, but this is what the producer price index measures. We'll talk about that and how that relates to the IPIC method in a moment here. The IPIC, again, what that does is it's a LIFO method, but what they do, instead of the company calculating what its costs are, it uses what they call the inventory price index computation. But basically, it's when you measure your inflation that you have, you're using those government price indices, that producer price index for it. It's not the actual inflation that a company may have. So this IPIC one is, I think the IRS prefers that method. It's not that you can't do your own method. Maybe they feel that that is more reflective of the inflation out there. And again, it's produced by a different government agency, the Department of Labor. But in some cases, you may actually get a higher inflation with these actual index price codes than the company is experiencing. Again, the higher the inflation, the better you are. So you might be having 8 to 10% inflation, but the IPIC calculation for the different codes that you have might be 15%, where you get to use that 15%, which again is going to provide more of a benefit. It is a very detailed process to go through and get the actual codes for your inventory and do that. But again, that's part of the process. One of the things they do is they try to look at the nature of your inventory, and they can establish it into what they call different pools. Generally, the fewer the number of the pools that you have for your LIFO inventory, the better the benefit that you may get with LIFO. But that's just part of the process that you need to go through when you're evaluating LIFO and making your adopting LIFO. Again, it's a complicated process to do that, but again, often worth the extra effort to do that. Now we're going to look at just, again, some of the process of adopting LIFO here with it. LIFO, again, is unique not only with the potential benefits you get, but even the way that you adopt it. They have a special form, and I put it on here, it's Form 970, and we'll provide a copy of that with the materials after the presentation here, along with the slides, just for you to have that for your reference. Normally, when you make a change of accounting method, you file, if any of you have done this, it's a Form 3115 for making the number of change of accounting methods. LIFO has its own form, though, again, that is this Form 970 when you adopt LIFO with it. Now, once you're on LIFO, there are some sub-methods within LIFO that sometimes you may need to change, whether it's a number of pools or how you calculate your LIFO. And with that, if you do that, that would involve a 3115, but that's after you've already been on LIFO. Again, just to adopt it initially, you need to do that Form 970. One thing with it is there's no IRS filing fee with it. You just complete the form, make sure you include everything with it, and then you'll file it with the tax return. The nice thing with this adopting LIFO is it can be made up until you file your tax return for the year, including if you're on an extension date with it. So you can go out to either September 15th or even October 15th with it. So even for the 2021 year, you could do that with the filing of your 2021 tax return. Okay, so it's a benefit that not only that you could get even after the tax year is over if you go out and calculate the savings with it. But one thing to note, and again, Silas is going to talk more on this, is there's the conformity rule. You need to be on, if you're on LIFO for tax, you also need to be on it for books or financial statement purposes. And, if you're getting ready to start working on your financial statements this year, those need to be on LIFO too. So you need to start working on that now, getting ready with it to talk to the applicable parties that you're going to work with your financial statements, talk to maybe your bankers or lenders with it to let them know that so that you get your financial statements done. Maybe those are done in February or March. Maybe your tax return is due in June. Need to get those financial statements on LIFO so that you can get the tax benefits when you file. And some, companies every now and then you'll get it where you talk about the LIFO and they say it looks good, but we'll just wait till next year. Well, yes, you can do it next year with it, but once you miss this year, you cannot go back and can never go back and get the prior year's inflation. Okay, you can capture the current year you adopt and going forward, but you can't go get back and capture any prior inflation. So, when you put that off and there's a significant benefit for it, you are missing out on that, and you can't go back and capture that. So that's just something to keep in mind as you evaluate this. Again, there is some advantages and disadvantages, and we'll go through some of those. It is some additional work with it. There is some annual costs going forward. Once you adopt LIFO, you're going to be on it in the future. You're going to have the annual calculations that you'll have with it. Again, much more work in the first year when you adopt it than there is going forward with it. But just thing to be aware with it. But again, with those costs, again, what you want to look at is identify as what are those savings? What is the real benefit that we're getting? And again, that can help digest and accept some of the annual costs and things that you have with it. Again, when you do file it, when you go to it, again, they do indicate some of the IRS, the regulations with LIFO. You adopt it, you need to identify, which LIFO method you're going to use. Your beginning inventory, when you go to it, needs to be at cost. That's one of the IRS requirements with it. So if you do have any prior write-downs that you may have had for tax purposes with your inventory, those need to be restored. So that's one thing just to be in mind. If you have taken some write-downs, and again, write-downs for tax purposes, not necessarily for book purposes, you need to restore those and bring those back in the income because you need to be on cost with it. The other thing I mentioned before, and again, Silas will talk on, is this LIFO conformity rule. This is one of the few areas in the tax law where if you're going to use this LIFO method for tax purposes to get the benefits, you also have to use it for financial statement purposes. Okay, so that's, again, if you're going to have lower income reported for tax, it's going to be lower income reported for book purposes, which again, you may not want, but again, the tax benefits may override it. There's actually a number of publicly traded companies that, again, obviously their earnings are very important, their book earnings, but they've even gone to adopt LIFO with it. And again, I think the analysts and ones that look at the company will, look at their company, realize they're in LIFO, but they're going to look at the FIFO number. They'll make that transition to it and realize that the company is doing that just for tax purposes. But there is this conformity rule. It's important that you're on it for book purposes. Somebody mentioned once that it's like, many of you are familiar with the bonus depreciation, 100% bonus depreciation used for tax purposes, very beneficial, but for book purposes, you may depreciate those items over 5 or 10 years. Well, the tax law doesn't require you to use, bonus depreciation for books. They let you, spread those out over the life of the assets. But again, for LIFO, that's one area where they do require that the book and tax use the same method. So something just to be aware of with it. Again, Silas is going to cover that. And again, once you're on LIFO, you need to continue to use that with it. And the last thing I just mentioned is make sure that you maintain your adequate records that you can document not only the year that you adopt LIFO, how you come up with your initial year with it, but each year after that. It's important to make sure you keep adequate records so you can support your costs with it. Because again, it might be 20 years later that you adopted LIFO, you still need to keep those records with it. It's an important part of it. And with that, we have our first polling question here with it. I'll read this one here for you so you can select the responses with it. What has been the approximate increase in the average purchase price of your products during 2021 compared to 2020? So go ahead and mark your response. We've got the increase over 25%, increase between 10 and 25%, increase up to 10%, no significant change at all during the year, or we actually had a decrease in prices over the year. So please indicate your response here. Okay, we'll close that polling question off then. Here's the responses. Interesting with it, we've got 30% that are over 25%, another 37%, actually the highest response between 10 and 25%, another 26%, about a quarter at 10%, and then a few with no change. So it's interesting that we've got almost 2/3 of the group here, 67%, that at least 10% inflation for the year. So interesting results with it. Any thoughts on that, Jerry? That's pretty significant levels of inflation that we've been hearing about.
Yeah, I think it mirrors what I've heard from many of the business owners and executives that I've talked to throughout the year, and I'm sure in many cases it's quite a bit higher than even our polls suggest.
Yeah, good. Okay, just a few other comments with as far as management's role in the LIFO adoption. Again, we kind of went through sort of the process with it. Again, I think it's important to do this, the thorough analysis, so you can really look at the advantages, the tax savings of going to LIFO, and some of the disadvantages, some of the costs, some of the extra work that you have to do with it. And I think it's important that you undertake that exercise so that you really figure out what the potential benefit is. And again, keep in mind with it is that it's not only this initial year that you adopt that you're going to get, but as inflation continues in the future, you may build on those savings in future years with it as well with it. You know, we've had some companies that start out maybe the first year, it's a $200,000 reserve, the next year, 300, and after 5-6 years, it's up over $1.5 million to $2 million with it. So it is something that builds over time with it. So you have to kind of look at what those potential benefits are, not only the current year, but going forward with it. And then you contrast that with some of the cost of going to it. Again, the conformity requirement that you have, again, that's definitely an issue that you're going to have to do. One thing with it, again, your financial statements, and Silas will go through, need to be on the LIFO as well. But if you've got bonuses or incentives for management, they're going to look at this and say, well, why would I go to this LIFO? It's going to show lower income, and we're going to get less of maybe a bonus or an incentive. Well, what you can do with those incentive plan or bonus plans that you may have or profit sharing arrangements is say, we're going to do those on a FIFO number. So we'll still reward those based on the performance of the company, based on a FIFO result, even though we're going to be on LIFO for our financial statements to get the tax benefits. If you're looking at an EBITDA calculation for a company, again, I think that you would look at the FIFO numbers and adjust that, not necessarily the LIFO number. So again, you can make adjustments for that for some of your calculation or metrics or things you're looking at. It's just that your actual financial statement, both the income statement and the balance sheet, need to be on LIFO. And again, Silas may touch on this too. If you do have some debt covenants with the bank or other lenders or other groups, you may need to work with those to see if those can be revised or updated to be on a FIFO basis and not on a LIFO basis with it. So that's again, part of the process. And if you're looking at, let's say you're going to adopt it for 2021 here, to start working with your bankers and others with them at this point with it.
Pardon me, Jim, I wanted to throw a comment in. One of our participants in today's webinar had wrote a question during the registration process, and they had indicated that their perception is that this is a one-time tax benefit followed by years of potential accounting headaches in the future. Is this still the case, they asked. And I think you hit on something very important to recognize, is that while the first year impact might be one of the larger impacts that you'll see or tax benefits you'll see, but you will continue to see an increase in that tax savings over a period of time. It's not uncommon for businesses to be on LIFO for 10, 20 years and have LIFO reserves that equal almost 50% of their FIFO dollars on their balance sheet. So that's quite a tax savings that they have. So I wanted to make sure I answered that question that came from a participant. Thanks for allowing me to jump in and reiterate what you had said earlier in the previous slide.
Yeah, that's good, Jerry. I think that's important to note with it, that 1 year savings may be larger this year just because the inflation is higher this year. We're getting this 10, 20, 50% inflation maybe, so you may get a real big bang for the buck this year by adopting LIFO. But it's not just that you're done this year. If the inflation, even if it moderates down, let's say you had a 30% inflation this year, you had a nice savings with it, with the LIFO if you adopted it, and maybe next year it's 10% or 5%, you're still going to benefit, maybe not as much, but it's going to continue. But it's something to follow with. And as you said, that some of the companies that have been on that for a number of years, you could probably chart over the time that they've had, ups and downs, but that the LIFO reserve has grown. And in some cases, you look at the benefit with it. I mean, that's almost as much as the equity of a company. In some cases, it can be very sizable if they've been on it for a long time. That kind of leads into this first example here that we've got, again, a straightforward one, but it kind of touches on the point as far as that benefit in the subsequent year. This company has $10 million that manufactures metal and products and widgets. It's on the FIFO method. The current year inflation again, we put down is 8%. Again, our actual inflation we saw with those metal products was in some cases well above that, but let's just say it's 8%. They could have an initial reserve of, let's say it works out, it's about $800,000 for that company. That provide, again, just using a 30% tax rate, almost $250,000 of savings that they would have for the year. But then in the subsequent year, in the second year, there's a 5%, let's say, inflation. So that's going to provide another savings of $150,000 for the company. So really, after 2 years, their savings is up to $390,000 in its first 2 years with it. So again, it sort of shows the impact that as they stay on LIFO, and if they have inflation, even as that moderates over time with it, that potential benefit is going to continue to grow with it over time. Next, here's just some illustrations. Again, somewhat the same topic with it here is, again, what we're just looking at here is the savings with it, again, just using a 30% tax rate. And we just put down, let's say a 2% inflation, 8% and 20%. Again, just three approximate amounts here. But you can see the savings with it. Even a company with $4 million of inventory, can provide a savings with it just in the first year with it, even up to almost $250,000 if we had 20% inflation. But a $20 million inventory company, you can see even with a 2% inflation, there's $120,000 first year savings that they could get. And again, if it's a steady 2% each year, you can see how that would even build over time with it. And again, if it's at the 20%, you can see it's over $1 million benefit with them. So again, it's just something just to point out that the impact of it over time, plus the higher the inflation, again, the more the benefit there. Next, just one thing to point out, I won't get too much details because this is a section that's out there. It's actually a relief provision that the Congress has put in the tax code that, again, sometimes you get situations, and again, I've not worked specifically, I know this is out there, but have not had to deal with it because it's one that, while it's available, the IRS needs to provide the relief for it. If there's certain interruptions, especially if there's some foreign interruptions of supply chains or items, that for embargoes or whatnot, that they can provide relief and say, let's say a company couldn't get its inventory, restore its inventory, and its inventory was reduced, let's say, in half because they couldn't get some items. They call what this is referred to often as the LIFO liquidation. You kind of reduce your inventory, and again, that may trigger some of the income. Some of that LIFO reserve may get paid back, and anyway, you can request relief, but the IRS actually needs to issue this relief and allow you then to restore your inventory back up to that level because of this unanticipated disruption in your inventory levels, and allow you not to have to recognize that income. So it is a relief mechanism that's out there. One that the bottom point I would like to highlight, the National Association of Auto Dealers has requested this 473 relief be provided by the IRS for auto dealers. Again, auto dealers have been on LIFO for a number of years just because of the continuing inflation that they have with new car prices. They've requested the IRS have that because, again, many the disruption with auto dealers can't get new vehicles with the chips and some of these other things that they do that. The IRS has not responded on that. So if they do get some of their LIFO reserve, liquidated, if you will, which might cause them some more income, again, paying back some of that benefit they got, if the IRS issues this relief here, then they'd be able to restore their inventories and not have to pay that additional income. So something to keep an eye on, especially if somebody works with auto dealers or other businesses, if the IRS does grant this relief. I think even members of Congress and the Senate have asked the IRS to do this. Next with it, I'd like to go through just some comments on M&A transactions, some things to be aware of with it. Again, we talked about when you're looking at a company, again, look at it on its FIFO numbers instead of LIFO when you're doing some of the analysis with the company and some of the metrics. If you're looking at your due diligence, if you're looking at a target that's been on LIFO, look at the 970 we talked about that you're adopting of LIFO. Any changes of methods, if they've made some sub-method changes, review those. Look at the codes that they may have if they're on that IPIC method. Check maybe some of the calculations, some of the layers, just to review that. I think it's important to review that, to get some comfort with it, make sure that they're on cost, they don't have write-downs for tax purposes, and some of the documentation. I think that's a part of the due diligence that you're going to have. I think it's especially important if you're acquiring a company and you're doing a stock deal where you're going to be inheriting that LIFO. That's going to be something that you're going to have. You may have to trigger that income at some point. If you sold it, that's something that you want to be comfortable with it. Review any IRS correspondence that they may have had related to their LIFO. If you're buying the target, if you're buying the assets of the company that's on LIFO, one thing, if you're the selling party with it, you may want to say, let's, when you do your purchase price allocation, you may want to say, let's just allocate the purchase price based on our LIFO cost, which again is lower, and they may leave more money toward your goodwill or intangibles that get a favored tax rate. If you're the buyer, however, you're going to want to insist that inventory be valued at its FIFO cost with it. So again, that's some of the negotiation that you may have with buyer and seller. But that's just a point to keep in mind then. And then the last thing here is, I said changes to LIFO. Well, actually, I could have left this page blank because there have not been any changes to LIFO, in recent years. There's been some talk over the last probably 15 to 20 years from time to time of some members of Congress saying that they want to repeal or limit the LIFO method in some manner. But none of these proposals have taken hold and no changes have been made. And I'll knock on wood, saying that. But a couple things, this Build Back Better that many of you are familiar with, that's working now in Congress, that the Senate has right now. There's no changes in LIFO in there, if you're wondering on that. The recent infrastructure bill that was just passed doesn't have any LIFO changes. Even back a couple years ago, the Tax Cut and Jobs Act, again, did not do anything with LIFO. So right now, there's no current proposals in it, but again, that could change at some point. And again, what would happen with it if they did it, some of the talk is what they would do is make you repay that LIFO reserve, which again, all those savings that you got could be repaid, which would be unfortunate. The other impact that you'd have is you wouldn't get any benefit of future inflation. So again, LIFO measures your savings that you already have up to date, plus any future savings. So if they took that out, it would have a significant impact on a lot of companies that have been on LIFO, really giving up all those savings and having future losses with it. So hopefully Congress will not make any changes with it, but it's always something to keep an eye on with it. So with that, I think we're set. I turn it over to Silas now to go through some of the financial reporting considerations with LIFO.
Thank you, Jim. Good morning, all. So LIFO is a tax benefit program for the most part, but like Jim said, there are some financial reporting implications. So before I go there, let me just do a brief introduction of myself. I am an audit partner at Sikich, performing financial statement, attest and consulting services, primarily for companies in the manufacturing and distribution industry, and for companies in the professional and business services. All right, with that, so let's briefly cover the impact of adopting LIFO inventory valuation method on financial reporting. We look at the IRS LIFO conformity rule, which Jim talked about, the change in accounting principle, that is the change from, let's say, FIFO inventory valuation method to the LIFO inventory valuation method. It's a change in accounting principle for US GAAP reporting purposes. We look at how the change in accounting principle is reflected in the financial statements. That is, would it require a retrospective or prospective presentation? How GAAP financial statements would be impacted upon adoption of the new accounting policy. And then finally, some potential internal and external factors to consider before making a decision to change the inventory valuation method from, say, FIFO to LIFO. Jim did cover some of this, but I'll just refresh that. So let's look at the IRS LIFO conformity rule. The Internal Revenue Service would allow companies to use the LIFO inventory valuation method only if they use the same valuation method for financial reporting purposes to ascertain the income, profit or loss to report to the owners, beneficiaries, or certain users of the financial statements, or for credit purposes, right? Say to your lender bank. So the primary GAAP financial statement of the company should be based on LIFO inventory valuation method. We cannot use LIFO for tax purposes and issue a FIFO basis financial statement for any of the above mentioned purposes. However, we could include supplemental FIFO schedules and add FIFO related information to the primary LIFO basis financial report. In a later slide, we have provided you with a web address to the Journal of Accountancy article, which have some illustration of LIFO financial reports with FIFO information added. Another factor to keep in mind is that although the LIFO inventory valuation method is an accepted valuation method for US GAAP financial reporting, it is not an accepted valuation method for IFRS, International Financial Reporting Standards. So a company which is required to issue their financial statements under IFRS cannot use LIFO inventory valuation method. Okay, so that's the IRS LIFO conformity rule. So next, change in accounting principle. So now that we have to change our financial reporting from say FIFO to LIFO basis, under US GAAP, the change in the method of inventory valuation from one accepted accounting method, FIFO, to another accepted accounting method, LIFO, is considered a change in accounting principle. A change in accounting principle is allowed only if it is due to either a new accounting standard, a newly issued codification, say like ASC 606, the revenue standard, or ASC 842, the upcoming new lease accounting standard. So those standards are changing, so it's a change in accounting principle. That is one, either that or the company can justify that the alternative accounting principle is preferable. Okay, those are the two or criteria that you have to meet. One of those criteria is to make a change in accounting principle. A change from say FIFO to LIFO is not a new standard. So obviously the company is making the change based on the preferability criteria. So voluntary change in accounting. So since the company is changing its inventory valuation method from FIFO to LIFO as a preference, it is considered a voluntary change in accounting principle. For such a change in accounting principle, the company is required to disclose in the notes to financial statements the justification for the preference, and the disclosure should be adequate. The company's auditors are required to make sure the company is meeting this reporting requirement. In this slide, we have listed a few factors which may apply to companies as potential justification. I'm not going to go through them. It's in the slide for your reference. Okay, so we have the next poll question. Jerry? Oh,
Yes.
was it Jim? Yeah.
Thank you, Silas. Sure. Our next quick poll question is, as of current year end, do you expect your company's on-hand inventory costs to be, and select one of the following for the poll, and we'll go over those results as soon as everyone has a chance to answer. I'll give you a minute here.
Like Jim said,
Go
ahead, sorry.
No, go ahead, Silas.
No, like I was trying to say, like Jim said, it's not only the inflation. As the company grow and as your inventory levels grow, obviously you'll have a benefit of tax deferral based on LIFO reserve. So go ahead, Jerry.
Here we have the results. About 24% of you said you'd have significantly higher cost, so with a 25% increase. Nearly 50% or 45% said marginally higher compared to 2020, and 17% said similar to 2020. I honestly a little surprised by that, but hopefully when you take a look at the cost benefit, maybe there's even larger opportunity for you.
All right. Thank you, Jerry. And I think that could be a combination of reasons too, because I know some of my clients or our clients, um, due to supply chain issues, they have a decline in inventory level. So though there is an inflation, there is a drop in the volume of or number of items they have. So there's a
Right.
combination, which could be the reason why that could be a reduction in total inventory cost. Thank you, Jerry. So let's keep moving. So we covered the IRS conformity requirement. We noted that it's a change in accounting principle. It's a voluntary change in accounting principle. Now let's look at how this change needs to be reflected in the company's financial statements. Okay, so retrospective application. Generally, the rule is changes in accounting principle would require a retrospective application of the change for financial reporting purposes. That is, implement the change as if the new principle has always been in use. So both the current year and the comparative prior numbers and related disclosures would be presented based on the new accounting principle with the cumulative adjustment made to the beginning retained earnings and the related asset and liabilities at the earliest period presented. So that is a general rule to do a retrospective application. Let's look at prospective application. There is an exception to the rule if it is impracticable to reflect the change retrospectively, right? So although the general rule is it should be done retrospectively, there is an exception to the rule. So if it is impractical to reflect the change retrospectively, then prospective application would be appropriate. This slide includes some summary information about when it is considered impracticable for your reference. Again, I'm not going to read through that. It's there on the slide. So GAAP financial statement presentation. The Accounting Standard Codification ASC specifically cites the change from FIFO to LIFO as a change in accounting principle, which could be considered impracticable to to adjust prior year balances. Hence, in most cases, a prospective application is appropriate. It could be considered impracticable because the records of inventory purchases and sales may no longer be available for all prior years, which may be required when you convert from FIFO to LIFO. So in the year of adoption of LIFO, no revision may be required to the beginning retained earnings, and the cumulative effect of the change will be reflected in the net income of the period of the change. So if you're implementing this in 2021, your net income, the cumulative effect will impact your 2021 net income. As I mentioned, there is an article in the Journal of Accountancy which has illustration of US GAAP financial statements presented for LIFO reporting. The web address of that article is included in the slide for your reference. The next slide, again, I'm not going to read through that. The slide has an illustration of the accounting policy disclosure related to the change in accounting principle from FIFO inventory valuation method to LIFO inventory valuation method. Right, again, it's there for your reference. This is required disclosure. Some form of this is a required disclosure, so we just added an illustration for your reference. Finally, let's look at some of the internal and external factors to be considered prior to the decision to change inventory valuation method, say from FIFO to LIFO. Jim covered a lot of this, but like Jim said, for tax, you have some time. You can wait until, say, you file your tax returns for 2021. But then the conformity rule, like I said, you need to have the same LIFO basis financial report for GAAP also, right? So timing is important. But let's see what really happens when you do a LIFO method of inventory valuation. Generally, what will happen is during inflation, it will result in a lower inventory amount in the balance sheet, right, compared to FIFO, and consequently an increase in the cost of sales for the reporting period, right? So there'll be a lower inventory amount in your balance sheet, and generally there'll be a reduction in net income because when your cost of sales go up, obviously your net income is going to come down. So there's going to be a reduction of inventory value in the balance sheet, and there's going to be a reduction in net income. So this obviously will impact some of your financial ratios, right? They're about two. Reduction in carrying cost of inventory and net income could adversely affect certain financial ratios, including current ratio, because current ratios are comparing your current ratio, current asset to current liabilities. Your current asset will be lower under LIFO compared to FIFO, so it will have an impact. Debt service coverage ratio. So debt service coverage ratio is based on operating income. Your operating income will be lower under LIFO compared to FIFO, so that'll have an impact. And potentially any EBITDA based ratios, right, would have an impact. So if you are required to issue US GAAP financial statements to your lender, again, please remember your primary US GAAP financial statement will be a LIFO based financial statement. Hence, you may have to discuss this with your lenders and consider making appropriate revisions to the covenant terms in the debt agreements. Second, borrowing-based calculation. If the company's credit facility is an asset-based lending facility, generally for manufacturing and distribution companies, borrowings could be based on a percentage of eligible inventories and accounts receivable. Again, since the company's primary US GAAP financial statement will be based on LIFO, the reduction in net inventory could reduce the borrowing base, how it is traditionally calculated. So here again, you have to discuss this with your banker and consider appropriate revision to the method of the borrowing base calculation. Third is incentive plans. Management should consider the potential impact of profitability based incentive plans, such as management bonus based on net income, right? So any change to LIFO inventory method could change or have an impact in the way you pay incentive or bonuses to your management team members. Fourth is M&A activities. Many times purchase price are based on multiples of EBITDA, right? So obviously EBITDA is going to be lower under LIFO compared to FIFO. So management should consider the potential purchase price impact on any ongoing or future M&A activities or buy-sell agreements. Also, it's very likely the buyer is assuming the future tax liability related to the LIFO reserve, right, which could impact the price of the deal. So just to be aware of that. And lastly, additional expenses. There will be an annual cost which will be incurred to perform LIFO inventory valuation, right? So at least on an annual basis, you have to do if you're not doing internally, you have to engage an external valuation specialist to do that. However, generally such cost could be insignificant compared to the tax deferral benefit from LIFO. All right, that's basically it. I think next we have another poll question. Jerry?
Yes, and after this quick poll question, I've got another question from a participant. So based on what you know about LIFO inventory method, how likely are you to change your company's method in 2021? Very likely, potentially, not likely, or unsure. Give you a minute to think about that. And I also have an additional question from one of our participants.
You could probably have another category in there too, Jerry. Maybe there's somebody who might already be on LIFO, but so they wouldn't be changing. They're already on there, that may already have benefited.
Right.
They may have more of a benefit this year.
Yeah.
Well.
Yeah, and I have had some clients who are currently at LIFO asking me, is it a good time to go back to FIFO? We did some analysis and we said, no, it's still worthwhile to remain on LIFO. So.
Very interesting results here. We have 7% indicating very likely that they'll change to LIFO, 22 saying potentially, but 54% saying not likely. That surprises me. And it kind of ties into some of the topics, Jim, that you mentioned earlier in your presentation about the complexities and the first year cost, and once you get over that cost, the calculation can be a bit overwhelming. So I think that might be impacting the answers here. but I would encourage you to at least take a look at the inflation and do a rough calculation as Jim presented in his slides on what that benefit might be, and to make sure that that you understand the tax savings. Also had another question from the audience with comparative financial statements, and this one I think for you, Silas, related to comparative financial statements. Would you start LIFO in the first year presented in comparative statements, or is this a prospective adoption?
Yeah, good question, a valid question too. So it is a prospective application. So though generally a retrospective application is required for most accounting changes or changes in accounting principle, ASC, the Accounting Standard Codification, specifically cites LIFO, where you can do a prospective application. So you will not need to change the prior numbers. Plus, you don't have to change your beginning retained earnings. You will just do that in the year of adoption, 2021. So obviously, it won't be apples to orange, but you can have supplemental schedules showing that the change, and you're required to show that change in a supplemental disclosure in the notes to financial statements. So the answer is it'll be a prospective presentation.
Thank you, Silas.
Sure.
Good. I don't see any other questions popping up in the chat. We are getting to the top of the hour.
I did see one, Jerry, here quick.
Oh, good.
Somebody asked if somebody were to elect off of LIFO, would they use the same Form 970 or Form 3115? Good question. That does come up occasionally with it, and you actually do the Form 3115 if you're going to elect off of LIFO. So that's a change of accounting and use the Form 3115. You would not use Form 970 for that if you had that situation.
And Jim, you can spread that impact over 4 years, correct? Like when you
Yes. What you do if you do a change of accounting that has what they call a positive impact on your income, it does actually defer that over a 4-year period with it, as opposed to taking it all in the current year. So, and that's one of the changes when you do a change of accounting on that Form 3115, is that if it's a deduction, a net deduction, you get it 1 year, and if it's an income, you get to spread it over 4 years. So
yeah, and it's not an automatic change. My understanding is you have to apply to the IRS, and the commissioner should agree to that change. Is what my understanding is. I think you have to have that communication with the IRS.
I believe that's right. I think it depends with it, Silas. I think it depends on how long you've been on LIFO. I think if it's and I'd have to verify
5
with
years.
it. I think it's a 5-year. If you've been at least on for 5 years, I think it would be an automatic change. Or if it's been less than that, you would need to request it from the IRS, in which, again, a little more involved process on that 3115, and there's a filing fee with it. But it generally would be one that they would accept with it, because again, if you're going to LIFO, it's probably going to have higher income, so they would probably accept that. But it is a little different process involved with it. So
yeah, it definitely is a big benefit, because I know Walmart, of all companies, they are under LIFO because of the tax benefit they get from the deferral. Yeah. So and many oil companies, many of them are under LIFO. So which could be the reason why US is hesitant to move to IFRS, because LIFO is not an allowed inventory valuation method under IFRS. So,
Gentlemen, I also have a question just came in just a minute ago. What are the next steps to begin evaluating this potential change?
I can go.
Go ahead.
The first one would be internal. If you have the wherewithal or the ability to do a look at, first take your 2021 numbers and see how much inflation is there in your product. Like, so if there is any inflation, like a 10% or 20% inflation, very likely you'll have a huge benefit by adopting LIFO. And the cost, though there is a cost of say doing LIFO valuation, there are a lot of good companies out there doing just LIFO valuation, and it's not that, again, it's all relative. I'm saying I've seen companies charge anywhere between 5 and 10 grand if it's not a very complex inventory structure. So So maybe for a $5,000 or $10,000 LIFO valuation charge, you could get benefit north of $100,000 if you have a say $1 million of inventory just with a 10% inflation rate. Um, so first thing would be to internally take a look at how your product and see what inflation, see if you have an increase in total quantity of inventory volume wise last year to this year. So just doing that initial analysis and estimating what potentially could be your and your growth pattern for the next 3 years. Like it is not a one-time deal. As the company grows, generally your inventory level goes up, and obviously you will have a benefit. It's a deferral of tax. And just to give an example, I have clients who have been using LIFO for more than 10, 15 years now. And each year, there are only 1 year, I believe, in the 15 years, there was a reversal, say close to 200 to 300,000 of LIFO reserve reduction. All the last 10 years, it's been, obviously the company is growing, so they have higher inventory, and obviously there is a build-up of LIFO reserve. So in the tune of north of $5 million. So that's a great deferral of tax, like almost a 2 million deferral at a 40% rate, cumulative federal and state. So sorry,
Sailesh, I
long
want to be
answer.
careful
Yeah.
of everyone's time, and I think what we can follow up with some additional information to finish answering that question. We're past the top of the hour. I want to remind everyone to stay on board to do the survey at the end of the presentation here. We can follow up with any questions you might have that we weren't able to get to. And keep in mind, your CP credit certificates will be sent out to you in the next couple of weeks. Thank you, Sailesh and Jim, for presenting, and thank you everyone
Thanks,
for
Jeremy.
attending today. Have a great day and a great weekend. Thank you.
Thank you.
Thank you.